The banking industry gives us an interesting example of how systemic risk gets created in our economy. Systemic risk is a risk that affects the economy, many firms in it. Here I'm using it to talk about all firms within the banking industry, as opposed to firm-specific risks. So what I'm going to go through here is show you how what we should have in the banking industry is firm-specific risk, but instead, and we'll talk about why, we have fundamentally risks that affect all banks. Okay, so the first thing let me describe a little bit of sort of what we should have in risk management in the banking industry, and what we've had in the past and what we have to some extent now, but we need a lot more of. Is what we need is bankers, fundamentally people with a lot of experience in financial institutions and financial markets, thinking about what could possibly go wrong in their book of assets. Different banks have different books of assets, so they look at their book and they say, okay, this is what we're exposed to. Maybe we're exposed to a lot of commercial real estate, and going through and really in a forward-looking manner, deciding what risks they have and what ways to mitigate, hedge, lessen those risks. I really highlight that tomorrow's risks aren't risks that we've seen in the past. What we're going to see when we have maybe regulators doing this is they're always looking at, well, this is the risk that happened. This is what blew up last year, so let's make sure that doesn't happen next year. You can see that in today's banking regulations, because they're looking at credit risk, a lot of credit risk. 2008 was credit risk. But what we're experiencing now in the bank failures is interest rate duration risk. So, and that was missed. So this is what we sort of should have in banking risk management. But what do we have, right? So what we have now is a lot. We have a Dodd-Frank, and we have so there's a lot of banking regulators, but I'm going to focus on the Fed, because the Fed provides scenarios. So these are scenarios. If you're interested in this, you can look at the CCAR process, and you can get these scenarios. But what the Fed does is it provides these scenarios to banks, and depending on your size, you can get sort of you have different requirements in looking at the scenarios. But fundamentally, we have different scenarios. Now, what a scenario is a set of macroeconomic variables. And again, I encourage you to take a look at this. It talks about, what's going on with the unemployment rate. Let's say this happens to the unemployment rate. This happens to energy prices. And it can get quite detailed in terms of even WTI versus Brent crude, different grades of crude oil, natural gas. This is what happens with metal prices. This is what happens with interest rates. So what the Fed does is provides these scenarios, and what the banks do is they feed these scenarios, and then they say, okay, what will happen to my assets under these scenarios, right? Provided by the Fed. And this is how risk management is done. Now, what this fundamentally becomes is we've taken sort of all the thinking. Remember, I started by saying we should have people with deep knowledge of financial markets and banking, right? People with 20, 30 years in the banking industry really looking at and deciding, what's a risk. But that's gone under this, right? People at banks are just taking Fed scenarios. The Fed scenarios come down and they just plug them into basically an IT system and chug it out, right? So, and then it says, okay, well, this is what happens to my equity, under this scenario, right? So it becomes an IT process. You might have a lot of people with finance degrees doing this, but in essence, they're just another IT department, right? They're just chugging through, running Fed scenarios through a computer. We can talk about a little bit of why this is. I have a couple excerpts from Jamie Dimon's letter to shareholders. This was a couple months ago, and to cite some things from there. So this is my experience in banking, but here's just a quote from Jamie Dimon talking about. This is a Wall Street Journal article quoting Jamie Dimon saying he chided management at the collapsed banks for failing to do more than the bare regulatory minimums. So what Jamie Dimon is saying here is, again, the banks are just taking the Fed scenarios and running with those. really, the banks could go above and beyond this, right? They could go above and beyond, and you run their own scenarios and so forth. And then that's what Jamie Dimon is saying that that they should do. Don't just do the minimum, do more. I've often found, however, that and banks, I can kind of explain why banks aren't doing more. I have the answer here, right? Because the Fed has become, since the bank bailouts, the Fed is, every bank knows that, okay, if I'm on the good side of regulators, there's a chance I'll get bailed out, right? So banks want to do what the regulators want them to do, and then they know, okay, I've got a chance. So in other words, banks are, from what I've seen, is they're scared to go out on their own and say, okay, well, this is the risk that I see, because then if it turns around and blows up, the regulators will be less likely to bail them out, right? So what we have, as noted by Jamie Dimon, is we have a system where the Fed creates scenarios and the banks are doing the bare minimum, running those scenarios, and that's risk management. That's what they're doing. My own speculation, again, is they're not doing it, and again, speculation from working in banking, that they want to stay on the good side of regulators, so they want to do what the regulators say and nothing more. They don't want to try their own thing, because when you do your own thing and it goes wrong, you bear the responsibility for it. They want to say, okay, well, I did what the Fed wanted me to do, so the Fed bears, I don't bear the responsibility, the Fed does. Okay, so this is what we have now. Again, stepping back, this is a creation of systemic risk. So the idea of this is, if each bank is doing its own, worried about its own book, doing its own thing, you may have some banks failing, right? The creation of systemic risk here is that, well, every bank is doing the same thing. They're all doing uniform risk management. And if the Fed scenarios are good, then this works out. But if the Fed scenarios are bad, then this is a problem, because all the banks are doing it, which means all the banks are going to be exposed to this risk that was overlooked. Now, is there evidence that the Fed scenarios maybe aren't the best? Well, yes, just as I alluded to before, the Fed scenarios tend to be backward looking. I'm not trying to knock the Fed here. It's just we as individuals are backward looking, because we see this happen in the past. We don't want it to happen in the future. It really takes people who are really good at banking to be able to look into the future. And this is not the people at the Fed. I'm talking about people with a lot of experience in lending and in community lending at commercial banks and so forth. So we see some evidence, going back to Dimon's letter here. Dimon said, he says, let's see, regulators pushed banks to hold super safe assets such as U.S. Treasuries, right? Which, let's unpack that. Treasuries are safe from default risk. They are not safe from interest rate risk. So if you were looking at 2008, you're saying, okay, well, I don't want a default event to happen, right? That's when banks held, there's a lot of default risk on their books, and these mortgages defaulted, and the mortgage-backed securities, defaulted and so forth. So these are safe. Treasuries are safe from a default risk standpoint. They are, however, depending on the duration of the Treasury, remember, duration is a measure of interest rate risk. 10-year Treasuries, 30-year Treasuries are very risky, right? So what the Fed is pushing banks to do is hold these securities which have a lot of interest rate risk and not a lot of, no default risk and a lot of interest rate risk. And what has happened over the past year? Interest rates jumped up, right? And this is what caused some of the recent bank failures in the last couple months. So the Fed, rising interest rates later dented the value of those securities, those treasury securities, leaving banks with large unrealized losses. So absolutely, we see evidence that the Fed scenarios are backward looking. More of Dimon's suggestions. He suggests to rework the Federal Reserve's annual stress test designed to measure banks' response to economic shocks. Right? It has been years since the test looked at the effect of rising interest rates. So Dimon is saying, okay, well, we need we need better stress testing. We need better scenarios, fundamentally, right? So there's evidence that, yes, they are backward looking. I should mention, the Silicon Valley Bank, Signature Bank, the failures of these expose, this is quoting Dimon, expose issues with bank management and supervision, particularly around risks associated with rising interest rates. So again, we've had these recent bank failures which are due to rising interest rates, and this was left out of the Fed scenarios, right? Or not left out, I should say. They wasn't the focus of them, right? So this is where we are. We've created, through the regulator and through the and I should mention, a lot of you maybe haven't been in markets since 2008, but these scenarios become much more important again with Dodd-Frank. Dodd-Frank is after the recent 2008 crisis. So there's become since 2008 there's become a lot of reliance on these scenarios, right? So as there's more reliance on these scenarios post 2008. There becomes just a more and more uniform approach to bank risk management, and then that is creating this sort of systemic risk where a lot of banks, and we saw this throughout the regional banks, a lot of banks are just overly exposed to interest rate, to duration risk. So how do we solve this? Well, it's interesting. There's a reason. Again, this is going a while back to shortly after the regional bank failure. So talking like 6 months ago, the Wall Street Journal was quoting Yellen, right, Treasury Secretary, and this is a very standard approach from people in government, but they're talking about, okay, we made it through this. This is because of our regulations, but we need to firm up our regulations. We need to fill in the gaps where regulation is lacking. So there's a couple. I have a couple quotes here, but anyway, but that's the gist of what Janet Yellen is saying fundamentally. That if something goes wrong here, it's evidence that, well, we need more regulation, right? So that's, again, how we got into this how we created this systemic risk. So we'll see what will happen going forward. I did this video one because I think now interest rates are started to really rise again, and they've stayed elevated, and the long end of the curve is rising. We see high mortgage rates over 7%. So we're likely to see some more interest rate risk related losses on banks in the near future. So going into how do we again solve this? There's this tension between, well, a lot of people in industry like Diamond are saying, the problem is the bank's reliance on these stress tests. A lot of the government is saying we need to make these stress tests more stringent, right? We need to give more power to the regulator. So unfortunately, like I say, I think if we go the route of more regulation, I don't think you can regulate. There's nothing. There's no way to regulate our way out of this. So it would be good. What I'd hope is we would more go the route of Jamie Dimon's advice, is to say, hey, banks, take a little bit of this on yourself. Don't do the bare minimums, and then. To be able to do that, the regulators would have to make it clear that they encourage banks to run their own scenarios and do their own stress testing. But ultimately, what was noted by Diamond there is kind of the way out of it. The banks really need to sort of take the reins on risk management. So we'll see what's going forward. We'll see what happens. I predict more regulation, but we'll see what happens going forward with bank risk management. But it should be interesting. So if you get a chance, check out the CCAR process check out some of these scenarios, and then keep an eye on regional banks. When we talk about banking crises, we have the too big to fail banks. So if you really want to see the effect of rising interest rates, watch the stock of a lot of regional banks and see what happens there. And then and hopefully we'll see more active risk management from banks in the future, not reliance on the Fed scenarios, and maybe a little bit of lessening of this systemic risk. Have a great day.